Good day, everyone. Welcome to our webinar for October. I want to begin by looking at the big picture, stepping back and looking at the context of where we are, where world markets generally are worldwide, and in that context, where's the JSE? But of course, like all markets, the JSE follows Wall Street, roughly, not exactly, but roughly. And the best way to measure Wall Street, of course, is with the S&P 500 index, which is an average of the 500 largest companies trading on the American Stock Exchange. We believe that there's a primary bull market, which began about 16 years ago, and you can see that on your chart here. Of course, this chart is a semi-logarithmic chart. And you can see the black swan event of COVID-19 over here. I regard that as an aberration from a technical point of view, because it wasn't caused by anything that was market related. But you'll notice that if you ignore that, then the market has been going up since 2009 in between two more or less parallel trend lines, an upper and a lower channel line. And it began in March 2009 at this level of 676. That's where the S&P was in March 2009 at its lowest point. And it's been going up steadily. And you can see that it took quite a while to get to 2,000. It got there in 2014. And then 3,000 also took quite a while. It got there in 2019. 4,000 came a bit quicker. It got there in 2021, and then 5,000 took longer again, and it was there in 2024. 6,000 came very quickly, as you can see, just less than a year later, about 11 months later. So there's been an acceleration in this trend. It's difficult to see the acceleration in a semi-logarithmic chart, and you can see that this chart is semi-logarithmic by seeing how the indexes, the y-axis has annotations that come closer and closer together the higher up you go. So if we take this chart and we put it into a normal chart, so what I'm going to do here is I'm going to take all these annotations off, all right, and then I'm going to change it into a normal. I'm going to change the scale type to a linear scale, and then you can see how it is definitely becoming exponential. So this is your low point down here at 767, and it's going up now faster and faster and faster. This is Trump's little V bottom that he made, and you can see that we're accelerating. The pace of increase is accelerating. Of course, I've been consistently bullish about this trend since 2009. And I did publish an article about that a little while ago. And I actually published it in this JSE handbook in the June 2009 edition, where I said that time, which is over here somewhere, was the greatest buying opportunity of the century, not of the year, not of the decade, but of the century. And so far, I've seen no reason to change that opinion. And then, of course, a couple of years ago, I posted on Twitter, X as it is now called, my calculation that indicated the S&P would reach a level of 6458. I did that at the beginning of 2024 when the S&P was still below 5,000. I said it's going to go up to 6458 within the next 2 years, and 19 months later it passed that level, so it's accelerating. I now predict that the S&P will get to 10,000, and it will probably go much higher than that. It's important to understand that the S&P is rising exponentially. That's really the message I'm trying to convey. The rate of increase is accelerating. And that, of course, is driven by advances in technology, which promise much better productivity and hence much better profits for the 500 companies in the S&P 500 index. AI is the main development at the moment, and it's driving shares virtually every day. But there are other advances that are coming through down the pipeline, like humanoid robotics, and also the improvements in solar energy, which are making energy far cheaper and will have an impact on profits of all companies throughout the world. It's almost impossible to assess the long-term effects of these technologies, but my guess is that they will continue to drive markets for quite a long period of time. In other words, we're not at the peak of this trend, and in fact, we're not even close to it in my view. As a private investor, you should be fully invested. That's my opinion. You should be fully invested in shares, good quality shares, but of course, nobody can be certain about what's going to happen in the market. So you must maintain your stop loss strategy. That is your protection. You can, of course, widen your stops if your investments go into the money. In other words, if they rise, if the stop loss level rises above the price that you paid for the share, you are in the money. And once you get there, you can start to widen your stops. So if you started with a 10% stop loss, you can maybe then go to a 15% stop loss. When you get to the point where the share has doubled what you paid for it, then you can possibly go to a 20% or even a 25% stop loss. But you can never ignore your stops. That's the key. Okay, so now I'd like to just take this chart back to the most recent situation. So I'm going to go back to a candlestick chart. I'll put a bit more data on the screen. Okay, and here you can see this is Trump's tariff V bottom here, and then the strong upward trend that we've got now. And the market has gone up very, very strongly, including last night, and it's reached this level of 6688. It's not the highest level, but it's very close to the highest level. We expect it to continue breaking new highs. Of course, nothing in the market moves in a straight line, so you should be expecting some kind of correction sooner or later. But at the moment, the market is running, and you should be part of that. The question, of course, always arises, is the market now overpriced? Is the S&P overpriced? In historical terms, there can be no doubt. It definitely is. The average PE of the 500 companies that make up the S&P is now 25.9. This is about 41% above the 20-year average of that PE. So it's definitely overpriced, but that does not necessarily mean that it is going to stop going up, that it is anywhere near a top. It does not necessarily mean it's going to fall now. Because we believe that as profits rise, so they will justify these high ratings, because that will obviously affect the price-earnings ratio. And most investors agree with me. That is why the market is running. The U.S. economy is powering ahead. Growth in the second quarter was 3.8%, which is very big for an economy of that size. The main driver was consumer spending and particularly business investment in intellectual property products like artificial intelligence. With the 25 basis point cut in interest rates, we expect the jobs market to recover relatively quickly, although the jobs report, which is coming out later this week, will tell us whether that is actually happening. Economists on quite a wide front have blamed Donald Trump's tariffs and his immigration policies for the slowdown in the jobs market, and they believe it to be temporary. Notably, the Supreme Court voted by 7-4 that most of Trump's tariffs are illegal. This will inevitably go further, and Trump does have a significant control over the legal system in America, so nobody can say whether or not it will see the light of day. But I believe that Trump's tariffs have been effectively blunted. The weekly claims for unemployment fell by 14,000 to 218,000. That's an indication that the job market is not so bad. And we believe that the S&P will continue to rise despite Trump and not because of him. The consumer price index in America was worse than expected in August, coming in at 0.4% for the month and 2.9% for the year. In fact, this was the worst level this year so far, and some think it may be because of the tariffs. But it was not enough to stop the Monetary Policy Committee from cutting interest rates by another 25 basis points. Housing costs were up 0.4% on the month, and food prices were up 0.5%. The coffee price has risen sharply because of Trump's tariffs. Personal consumption expenditure came in at 3.1%, and you mustn't forget that that is the Fed's preferred measure of inflation in America, and it is still well above the Fed's goal of 2%. But we believe rates will continue to fall, and AI will continue to boost the profits of major companies in America. All right, so much for America. Let's turn our attention now to Ukraine. After 3.5 years of war, the Russian economy is clearly taking strain. The CEO of Sberbank, which is probably Russia's biggest bank, or biggest commercial bank, says that the economy is on the edge of recession. He is suggesting that the central bank cuts interest rates by a whopping 6% to help consumers and businesses and to avoid recession. Interest rates are currently at 18% and have been as high as 21%. We believe that in the end it is economic failure that will bring Putin to the negotiating table. On the night of the 7th of September, 2025, just the other day, Russia sent 805 drones and 13 missiles into Ukraine. Ukraine managed to destroy 751 drones and 4 missiles, but some of them got through and 4 people were killed, including a child. The attack shows that Trump's meeting with Putin in Alaska was a farce. Putin is not interested in a ceasefire or peace talks. Trump finally seems to be understanding this, so he has switched sides. He is now threatening Russia with more serious sanctions and threatening them that he will support Ukraine. He also proposed that he will apply sanctions on other countries that are supporting Putin, such as India, China, Hungary, and Slovakia. Coming from Trump, however, this must be viewed with some skepticism. We'll believe it when it happens. European leaders, the so-called coalition of the willing, have also been talking about more sanctions. They're even talking about putting troops on the ground in Ukraine. That, of course, would be a major escalation of the war. But it would probably force Putin to accept that he has lost this war. Ukraine's consistent and continuous attacks on Russian oil facilities is beginning to take a serious toll. It is now estimated that Russia has lost nearly as much as 25% of their oil production. Motorists in some parts of Russia cannot get fuel for their vehicles. Many petrol stations don't have petrol. There's rationing being implemented. So it's not looking so good. And of course, all of this comes home to the Russian consumer. There's also been a noticeable change on the battlefield as Russian troops are not getting the fuel that they need to run the equipment that they have. There can be little doubt that Ukraine is beginning to win the drone war. Okay, let's turn our attention now to the political situation here in South Africa. A recent Ipsos poll found that 80% of South Africans are pessimistic about the government of national unity. This compares with 40% just after it came into power. The problem seems to be the perception that nothing has changed, especially with service delivery. The ANC, of course, has 159 seats in Parliament, and the DA has 87. But the ANC's support is falling. This is especially true in the major metros like Johannesburg and Tshwane. We believe that the government of national unity is on a steep learning curve. It should slowly begin to perform better, but patience is required. Much now, of course, depends on the outcome of next year's municipal elections. Patricia de Lille is holding a symposium where each department of the government will present its ideas for accelerating growth. And growth, of course, is the key. Idealism is substantially dead in this country. The voters are not interested in arguments, they want services. And the DA has built a strong track record of service delivery. All right, let's look at the economy now. The Monetary Policy Committee kept rates unchanged. We know that. 2 members of the committee wanted a 25 basis point cut, but the unchanged decision carried the day. Commodities, of course, especially gold and platinum, have benefited South Africa strongly. The decline in the US dollar has also obviously helped the rand. The Reserve Bank has increased its growth forecast to 1.2% for this year, 2025, from 0.9%. We believe that that is still quite conservative. Trump's tariffs are not expected to have a long-term effect on the economy, but they will impact in the third and fourth quarters. Exports from South Africa to America decreased by 18% in the first quarter. Vehicles and motor parts dropped by 53%, and precious metals and stones were down 6%. Our exporters, of course, are looking for new markets for their products. We believe that the Reserve Bank's conservative management of the money supply is having a strong positive impact on the economy. South Africans are becoming a nation of savers, not spenders. The CPI was 3.3% in August, down from July's 3.5%. Food inflation was down to 5.2% from July's 5.7%. That was due to the good harvest and also the lower fuel prices. This gives the Monetary Policy Committee some room to cut interest rates further before the end of the year. Core inflation was 3.1%, very near to Letecha Kanyago's target of 3%. The Bureau of Economic Research survey shows that inflationary expectations are at a record low of 4.2%. Moody's says that interest rates in South Africa are much higher than in other emerging market economies like Poland, India, Malaysia, and Romania. They say that the high cost of borrowing could stunt growth. But of course, this signals a shift in consumer and business expectations. Consumers are busy paying off debt and saving because of the high interest rates. Interest rates are expected to continue falling, but the Monetary Policy Committee aims to keep SA bonds very attractive for overseas investors. Gross domestic product increased by 0.8% in the second quarter, up from 0.1% in the first quarter. This is the equivalent of 3.5% per annum, and that is well ahead of the GNU's goal of 3%. Gold and chrome were both stronger, and agriculture was up 2.5%. Manufacturing increased by 1.8%, and household consumption was up 0.8%. This shows the impact of lower inflation and the higher real level of wages. We believe that economists in South Africa generally are underestimating South Africa's growth potential. Retail sales were up 5.6% in real terms in the year to the 31st of July 2025. That shows the impact of rising wages relative to inflation. Textiles, clothing, and footwear grew by 10%. Hardware, paint, and glass were up 13.2%. Lower interest rates are stimulating home improvements. The current account of the balance of payments had a large deficit of 82.8 billion in the second quarter. Exports were down and imports were up. Dividend and interest payments to foreigners increased substantially. The trade account shows exports down to 117 billion from the first quarter's 211 billion, while imports were up by 8.2 billion. The rand fell against a trade-weighted basket of currencies, even though it strengthened against the US dollar. A weaker rand encourages exports and discourages imports. The South African economy, of course, is still primarily an exporter of raw materials. Improved logistics, especially at the ports, is beginning to help exports. Goldman Sachs predicts that the South African economy will grow by 1% in 2025, but that growth will rise to 2.5% per annum in the medium term over the next few years. They base this on declining interest rates, improved logistics, low inflation, and potential sovereign credit ratings upgrades, so that all looks good. The ABSA Purchasing Managers Index fell back below 50 in August. Weak demand and obviously the US tariffs had an impact. The second quarter as a whole should be better than the third. It should be back above 50. New sales orders fell sharply because of the tariffs. The Competition Commission has reported that electricity price in South Africa has increased by 68% since 2020, and water has gone up by 50%. During that same period, inflation was only 28%, so this is bad for consumers. Water and electricity is rising much faster than the inflation rate. Eskom, of course, has won a court case which allows it to recover 54 billion rand from consumers over the next couple of years. This will drive even more people away from Eskom to alternative energy sources like solar power. And Eskom will become progressively less and less viable. The Minister of Labour has drafted new rules for small businesses. These make it easier and quicker and cheaper for these businesses to fire employees. Currently, the draconian labour laws make it very difficult, time-consuming and expensive to fire anybody. And business has blamed these laws for the high level of unemployment. Because it is difficult to fire, businesses avoid hiring at all costs. Beneficiation, another subject, has always been a goal here in South Africa. We have always been an exporter of raw materials and an importer of finished goods. But we have about 80% of the world's chrome here in South Africa. And we export that chrome to China. We also have huge reserves of iron ore. But we import steel from China. So we send our chrome over to China, they turn it into steel, and they send it back here to South Africa. This is mainly because Eskom has pushed the price of electricity so high that it is not viable to smelt steel in this country. Over the past 20 years, the price of electricity has gone up tenfold. And that is due to the mismanagement, corruption and nepotism which has been allowed by the ANC. Thousands of people have lost their jobs in the steel industry in this country. Glencore's CEO says that South Africa is losing the steel industry, and that's mostly because electricity in China costs about half of what it does now in South Africa. All right, let's look at the rand. Okay, just going to switch the chart here. So the rand has been affected by investors' risk on and risk off sentiment. We've talked about this on many occasions. Here you can see the rand. It reached an intraday high of 1993 against the US dollar on the 9th of April this year, but since then Trump has been backing off on his tariffs to some extent, and the rand has been benefiting. For a while it met resistance here at 17 Rand 50 to the US dollar. It bounced that level 4 times, in fact, before breaking decisively down through that level, and it now seems to have found a new level somewhere around 17.25. So we'll see how that goes. But in my view, the rand is going to continue strengthening. Of course, one of the factors in this rand chart is the weakening of the US dollar. The US dollar has been weakening against other major currencies most of this year. We believe that eventually the rand's position against the US dollar will break below 17.11, which is the cyclical low that it made on the 27th of September last year. That was nearly a year ago, before the elections and before Trump's accession. A stronger rand, of course, is good for South Africa because it reduces prices, especially of fuel. It does, however, make our exports more expensive on the world markets. All right, let's look at some other commodities. First of all, I want to start by looking at the platinum price. Okay, so platinum. The World Platinum Investment Council says that prices will continue to rise. They report a deficit of 850,000 ounces. I'm just going to put a bit more data on the screen here. I actually put a lot on. Just go back and see where we are. All right, there you can see it. Right, there's the subprime crisis of 2008, and since that boom in the 2007 years, the platinum price has been falling. But it made a significant, here's COVID-19, of course, down here, and it made a significant upside break through that trend line just the other day. And it's been accelerating. The platinum price has been accelerating upwards. And one of the reasons for this is that up until this break here, there was almost no investment in platinum. In fact, last year, about 10,000 workers were retrenched in the South Africa's platinum industry. Now suddenly there's a massive shortage of platinum. Global superpowers are trying desperately to secure stocks. It's used in military technology, in hybrid electric vehicles, in renewable energy, all sorts of modern industries. So now it's going up, and it's quite similar in a way to gold. Gold broke up, as you may remember, a while back, and now platinum has done exactly the same thing. In fact, since last month's confidential report, where we first reported on platinum, it's gone up another 12%. So it's really shooting up. And shares like Sibanye, of course, are benefiting directly. If we turn our attention now to the other precious metal, gold, which is so important to South Africa, it's reached a new record level. Here you can see it now. It's at this new record level, the 3850. And in fact, it went higher than that, I think, overnight. But what I'm trying to say is that it's at record levels. You see here it reached a resistance at 3424, bounced that level 4 times, then broke up decisively over here in late August and early September. And since then it's been going up at a fantastic pace. The world's gold supply is obviously very important. Between 1990 and 2024, 350 gold deposits were discovered, and these discoveries delivered about 3 billion ounces of new reserves to the gold market. But since 2020, only 6 deposits have been found, and they've only added 27 million ounces. Exploration has not kept up with demand. Central banks are buying gold all the time, and this is pushing the gold price up. So the wars also in Ukraine and the Middle East are fueling uncertainty amongst investors. And of course the US dollar has been falling this year, as we mentioned earlier. That also helps the gold price. South Africa's problem, of course, is that our gold reserves are now mostly too deep to be exploited profitably. We produced in 1970 about 1,000 tons of gold. In fact, that production that year, 1970, we produced more gold here in South Africa than all the countries of the world put together, than all the other gold producers put together. Today we produce less than 100 tons, and we are the 10th largest producer in the world. On the winning shares list, we have got 5 major gold shares. Pan-African, which is up 369% since we put it on. Harmony, which is up 219. Anglo Gold, which is up 203. Goldfields, which is up 117, and DRD Gold, which is up 113. So go and take a look at the winning shares list and you'll see how well you could have done in these shares. We do not think that this upward trend in gold is finished. We think it's just getting going. All right, let's turn our attention to some of the new listings on the stock exchange. We've had 2 important new listings. ASP Isotopes, which produces and sells radioactive substances like ytterbium 176 and silicon 28. Ytterbium 176 is used in the treatment of prostate cancer. It's used, they put tiny seeds of ytterbium into your prostate, and it is radioactive and it kills the cancer. And all men are getting prostate cancer these days. They say that every man will get prostate cancer if he lives long enough. So ytterbium or terbium is very expensive, but it works. And it's a very good business to be in, obviously. Silicon 28 is used in quantum computing and in next generation semiconductors. It's critical for high performance microchips and what are called nanowires. So these two radioisotopes and the others which ASP Isotopes is exploiting are likely to have a big market. So that's something to think about. The share has only just come onto the market, and it's early days now. We still can't make a technical assessment of it. The other new listing is a company called Greencoat New Renewables. Greencoat New Renewables. And this company owns 40 renewable energy sites in Europe. So they produce renewable energy. They're taking advantage of Europe's move towards carbon neutrality by the year 2050. They produce about 1.5 gigawatts of power in 5 European countries. 97% of the energy that they produce is from wind, both onshore and offshore. 55% is generated in Ireland, 22% in Germany, 10% in Sweden, 8% in France, and 3% in Spain. Both of these companies are exploiting cutting-edge technologies. Neither one is cheap, and both would involve some risk. But they both have enormous blue sky potential for capital gain. Neither one of them has been on the market for long enough for me to make a technical assessment. And of course, neither one of them has yet made it onto the winning shares list, so perhaps you should wait for that. Okay, let's look at some other companies. Pan-African, we mentioned that last month, but really I apologize for bringing it up again. But since we added it, since we talked about it last month, it's gone up a further amount. It's gone up by, let's see now. It was at 1633 at last month's report, and it closed yesterday at 2018. So it's gone up enormously. Since we added it to the winning shares list on the 31st of January 2024 at 430 cents, it's gone up 369%. We believe it will continue to perform as gold is climbing, and we expect gold to continue climbing. So just drawing your attention to it again, Pan-African. If you're not already in there, perhaps you should consider it. Okay, the next share I want to talk about is Naspers. Now, Naspers has been one of our favorite shares for a long time because Koos Bekker, the CEO of Naspers, or the chairman, is always trying to unlock value for shareholders. The company has a difficult capital structure. You can see here, it was added to the winning shares list over here on the 15th of February this year. It was then 4,600 Rand a share. It closed last night at 6,254 Rand a share, so it's doing pretty well. The problem with the share capital is that it has 907,128 ordinary shares, and each one of those shares has 1,000 times the voting power of the 439.8 million N shares, which it has in issue. So effectively, the ordinary shares, which are less than 1 million, have 67.4% of the vote in the company, but they obviously contributed less than 1% of the capital. So they control the company without having put in a lot of capital. Bekker is always trying to give the end shareholders some value, and his latest effort is that Naspers is going to do a 5-for-1 split. In other words, a person with 1,000 shares trading at about, 6,254 will then have 5,000 shares trading at about 1,200 Rand each. The value of his holding won't change in theory, but when you get a share split, it brings the share price down dramatically, and that brings it within the range of a much wider group of shareholders, and generally the share price goes up as a result. All right, we added Naspers to the winning shares list on the 15th of February this year at 4,600 Rand a share. It's now, as I pointed out, 6,254 Rand, so it's gone up about 35% in 7.5 months. Okay, the next share I want to talk about is Outsurance. This is, of course, what remains of Rand Merchant Bank after they unbundled Discovery and Momet and sold off their 30% stake in Hastings. Just want to put this bit more of this on the screen. We added the company to the winning shares list. We always thought this was going to be a solid blue chip investment, of course, because what's left is Outsurance after they got rid of all those things. We added it to the winning shares list on the 15th of February at 4,457 cents a share. and we see it still as a very solid blue chip. As you can see, it's come off a little bit in the last couple of months, so it's looking cheap to us. We see it as being in a steady upward trend, and the recent sell-off is, in our opinion, a buying opportunity. You should certainly watch the share and wait for the right moment, but we like it. Okay, the next one I want to talk about is Attack. Attack, of course, is a property development company which listed in 2013 and then became a real estate investment trust in 2018. And it owns the Mall of Africa. I'm just going to put again more data on the screen. It owns the Mall of Africa, and it also owns the Waterfall Estate, the Waterfall Complex, should I say. And it's now building Waterfall Ellipse, which will be 590 apartments in a high-rise residential building. These will be priced at between $1.5 million and $12 million. So this is a real money spinner. Overall, Waterfall City is expected to have be more than 1 million square meters of mixed-use space. We like this real estate investment trust because of its very low loan-to-value, only 25.3%. The risk is very low, and it has loads of cash to take advantage of any opportunities. Property generally is performing very well at the moment. And you can see here that after a long period of sideways movement on this side of the chart, that the share broke up over here, and we added it to the winning shares list, and it's going very well now. So it's gone from 964 cents, and it's now at about 1,380 or somewhere around there. Finally, I'd just like to come back to an old favorite of mine, Choppies. You know Choppies, it's a grocery store outlet, but they don't have any grocery stores now in South Africa. They've got rid of them all. Not quite sure what's going on here. Cancel that. Let's go here. I just want to put a bit more data on. And again, it's one of these shares that had a long period of sideways movement and then broke up over here. And we added it to the winning shares list at 85 cents on the 6th of March this year. And it's been rising at a strong upward trend. And as you can see, from 85 cents, it's gone up to 198 cents, which is where it closed last night. This company has made a speciality out of running grocery stores in the rest of Africa, outside of South Africa. Of course, some of the big retailing grocery companies in this country, like Pick n Pay and ShopRite Checkers, have done their best to break into the African market to the north, but they've had a lot of problems there with high inflation rates and the political uncertainty, difficulty of resupplying these stores and so forth. And that is what Choppies does. They have made a speciality out of running grocery stores in the rest of Africa. I believe that they will actually be a takeover target. In other words, I'm thinking that one of these big local grocery retail outlets is going to make an offer to buy Choppies at some point. Choppies, of course, is expanding rapidly, and they've gone up very nicely. We put them on the winning shares list on the 6th of March at 85 cents. They're now at 198, and I think the share will continue to rise. All right, folks, that's about what I've got for you today. I hope that you found something of interest in this presentation. Don't forget to look at the notes. And remember that you can contact me on WhatsApp. My number is 071 5022 383. You can send me a message or phone me if you want to talk about specific shares. The only question I won't answer is if you ask me, should I buy this share today? Because I'm obviously trying to teach you to do that decision for yourself, to make that decision for yourself. But otherwise, feel free to contact me. So I'll give you that number again, 071 5022 383. Thank you for listening to me.